Hey everybody, Jeff here with the September market update, and we are joined by Head of Sales at RCN Capital, Mr. Chris Dorin.
Thank you, Jeff.
Good to have you back, Chris.
Great.
And of course, Rick, how are we doing today?
Doing as well as I can be, Jeff. Thanks for asking.
Fair enough, fair enough. So let's get right into it. We are in early September, and this evening is the presidential debate, and certainly the topic that most folks are going to be interested in is housing. Well, maybe they won't be, but it'll certainly be one of the questions as we continue to be so undersupplied in the single family housing marketplace in the United States. Both sides, I'm sure, are going to have proposals. Rick, any thoughts on blue or red, and which side maybe has some proposals to help put a dent in this housing shortage in the U.S.?
Yeah, the two campaigns both do have very almost predictable approaches to the housing market issues. But what's really interesting to me is that this is the first time, probably in recent memory during a presidential election year, that housing has been considered important enough to be a discussion topic. And I think that's probably, and we'll talk about this later, I'm sure, but it's probably because affordability for first-time buyers is as bad as it's ever been historically. On the Democrat side, the Harris-Walz campaign has put out some specific proposals, very similar to some of the things that the Biden administration has been talking about. The one that gets most of the press because it's a bright, shiny object is a $25,000 credit for first-time buyers to use as part of their down payment assistance to help offset limited affordability. And that's one of those proposals that sounds really good, but in practical use probably isn't quite as good as it seems. Always nice to have somebody write you a check for $25,000, but the problem we have in today's market, as you alluded to, Jeff, is limited supply compared to demand. Enticing people with a $25,000 check to go buy a house actually creates more demand without necessarily creating more supply. So what you wind up with is a situation where you're trying to help people afford to buy a house and inadvertently causing the price of homes to go up because there are more people looking for that limited supply of homes available for sale. So long run, that one's probably not a great approach to solving the problem we currently have. On the other hand, the Harris and Walz proposal does talk about government initiatives which would entice builders to create more properties, particularly more properties for first-time buyers. And that's probably the part of the market where we have the most severe shortage. A lot of the challenges have to do with working with local and regional and state governments to try and cut through some of the regulatory issues that builders have to deal with, a lot of the red tape. A lot of the cost involved in building a house happens before ground is even broken. And so anything that the federal government can do to help streamline that part of the process would really be helpful. On the side of the fence with former President Trump and Vance, really what they're talking about is more freeing up the market from regulatory constraints and allowing builders an easier time of putting shovels in the ground and starting to put properties up. The other thing they're talking about is bringing private capital into the market. Ostensibly, that would reduce the government's footprint in the mortgage industry. And given the fact that something like 75% of all mortgages have the government touching them one way or the other in today's market, that's an initiative that would have to be taken on very, very carefully, or you could disrupt the whole lending ecosystem. And then finally, I think if former President Trump were back in office, you'd probably see an expansion of the Opportunity Zone program that was actually, I think, a little bit more successful than most people realize at having capital injected into underserved communities, into economically challenged communities, and creating more building, more housing in those markets. So it, again, very different approaches. One, a much more direct government hands-on approach, one an attempt to get the government out of the way of private industry. It'll be interesting to see which approach plays well with the audience tonight.
Chris, I know one of the concerns of investors today, and I'm sure this is on both sides of the aisle, is legislation that is aimed at limiting the amount of investment activity there is for non-owner occupied investment on single family houses, really across the US. My guess is you hear this from investors all the time.
Actually, I hear it from non-investors more often than investors. Investors only on the fear side of things, right?
Sure.
They're afraid that their opportunities might be limited or capped in some way, right? And I see this on social media all the time, right? People putting out numbers like 43% of US homes are being bought by, these big hedge funds or whatever. It's just not true. So if you're living on TikTok or, Twitter X, whatever they're calling it these days, you're probably getting some bad information, which shouldn't be a surprise to anybody who's living on socials. There's a lot of bad information out there. But, I think when people are working with real data and they're seeing the real numbers, the impact that investors have on the, supply and demand issues that might be existing to the home buyer market. In some markets, maybe it's a little bit more impactful, but on the whole, you're talking about less than 1% here. They're not coming in to take up all the inventory in your neighborhood. That's just not happening. You're not seeing, neighborhoods converted to Airbnbs despite the fears of the growing population, right? It's this little thing where a little spark in the kind of social media atmosphere can suddenly take on this whole new life of its own. And it gets this big following of people who get behind it. But the reality is the numbers don't back that up. And I do get concerned about, people in Congress, especially saying things like, oh, we need to do something to solve this problem, but they're solving a problem that doesn't exist. And that would be a form of government for sure that we might be used to in all parts of the world. But I think at the end of the day, and, Rick, you were talking about this too, real estate is a really, local business at the end of the day, right? And so saying things like we're going to pull out regulations and do this, or we're going to do this to regulate this sector here, it kind of doesn't jive with the actual reality of how real estate markets work, right? It's a bunch of local businesses and local communities who really set the standards and do these things. So I think there will be great talking points at the presidential debates about housing because it is such an important factor for people. Rick, to your point, though, I think that the real impact of those things is probably pretty limited, though, because of the way the industry just works as a whole and how it is a local thing to, get regulations and permits and approvals for things for building projects and things like that, too.
Well, politicians rarely lose votes by targeting lenders or targeting investors in this economy, this ecosystem, particularly investors. There's no shortage of bad legislation being promoted at the moment. The legislation you're talking about, Chris, would basically require anybody with more than 50 rental units to consider at least selling them off because they're going to lose all their tax benefits of owning those properties. And that's intended to thwart institutional investors, which is just a huge joke and really kind of a slap in the face of the English language, because institutions don't own 50 properties. Institutions own thousands of properties. But to your point, they only own about 3% of the overall market of single family rental units. 90% of those properties are owned by mom and pop investors who may own 10 or fewer. And then there's smaller investors that'll own, a few dozen or a few hundred properties across the country. We're also seeing proposals for rent control, which is one of the few initiatives I've seen economists on both the left and the right side of the political spectrum agree that it's a terrible program. It never does exactly what it's intended to do. But of course, it's very popular among current tenants who don't want to see their rent rates go up. But it ultimately results in fewer properties being built, in the properties that are already built being maintained worse and worse. And ultimately rents go up because there's nothing new being built while population is growing. And then the third anti-investor proposal is actually from the Harrison Walz campaign, which is a 45% tax rate on capital gains. So if you're an investor and you're looking at buying and selling properties, that 45% hit is just a massive number. It's more than twice the current rate. And I believe it would be just about the highest capital gains rate we've ever seen. But clearly something aimed not just at high net worth individuals, but also at this investor community.
So when we think about the various proposals, maybe you could just highlight a couple of proposals that would actually address the lack of new construction in the US. And when I say lack, we are building in the US today, but we're really not building enough to put a measurable dent in the deficit that we have.
Well, the problem with our current inventory of homes is that the industry has underbuilt for over a decade. We were overbuilt, which in part led to the housing market crash that precipitated the Great Recession. But builders simply haven't come back since then and have been underbuilding for years. At the same time, we've seen population grow, and we've also seen a pretty significant growth in people reaching prime age for household formation and for home ownership. According to some research from John Burns, there are 13,000 people turning 35 every day across the country. That again is the prime age for being a first-time buyer, prime age for forming a household, and there's just nowhere for these people to live, which has been a problem. We are seeing the builders come back a little bit, but what's kind of fascinating is they're not necessarily building where we have the most severe shortages. They tend to be following some population migration patterns. So we're seeing builders build a lot more in the Midwest. They're building more in the Southeast and the South, where people are moving. And interestingly enough, where the housing shortages aren't as severe. They may have actually already overbuilt in some markets in Florida and Texas, anticipating a continued population surge in those markets. But in places like California, where there's a severe shortage, you're not seeing as much building. And that's unfortunately true in some of the markets where we do have more severe shortages. One of the reasons for California being underbuilt right now is the regulatory hurdles builders have to go through before they break ground. Most of the builders I've talked to out here say it takes at least 2 years from the time they apply for a permit until the time they can actually start breaking ground and building a property. So there may be some of that work going on in the background, but until we remove some of this red tape, until we make some of the zoning regulations and zoning rules a little easier for builders to comply with, it's just unlikely we're going to see some of these markets have the kind of building we need to meet demand.
So I'm going to pivot and go to rates. A favorite topic, Rick and Chris, of both non-occupied investors, our customers at RCN, as well as homeowners as well. Chairman Powell has laid out a path, it appears, for rate reduction. It started with a very, we'll call it exuberant speech in Wyoming, and hopefully will culminate on September 17th with some sort of a rate reduction. Chris, once again, what are you hearing from folks on rates? Are folks waiting for the reduction to act on purchasing or refining? Kind of what's the sentiment out there today?
There's always going to be a segment of the population that when they hear rates are coming down, they're going to wait forever. They'll miss the boat. They're going to wait so long. But the savvier players understand. They've already, if you're watching the markets, you're going to see that the bond market has already reacted to the news of the day. So all of Chairman Powell's kind of commentary about where the expectations are going for September 17, those are kind of baked into that part of the market. One of the things that, we've seen is a little bit of a slow downward trend here in the rates, which has been very helpful for investors and non-investors alike. But that should continue a nice slow pace here. I wouldn't be too excited that we're going to suddenly have a big drop off in rates, right? I don't think anybody's anticipating a big, fall off anytime soon. It should be a little bit more of a steadier decline. And this follows with Chairman Powell's comments about, wanting to aim for that soft landing, right? Something where, you're anticipating the economy might be getting close to that recession. We've seen job numbers come down a little bit, right? This maybe is that indication that they're looking for to, start to turn the ship a little bit, right? And it's a big ship. It takes a little while before that data starts to show itself and reveal itself in the numbers, but we're starting to see those cracks in it, right? You're starting to see the effects that they've had on the economy with the rising rate environment that we've experienced. Now we're heading to this lower rate environment. Hopefully that'll be a little bit more stable. And that stability is going to bring good things for the market too, where even if the Fed is not lowering rates, we could still see rates continue to drop because of stability. And that's what I'm most excited about, to be honest, because as a lender, you want that certainty in the marketplace to know that when you advertise a rate, it's going to be there and it's going to be reliable for you, right? And you don't have to move pricing too quickly. And I think the market in general, the customer side of it, will be very grateful to have some stability in markets, because it wasn't that long ago we were doing 3.5% rates, and then it was up to 8% rates, and now we're kind of teetering back down in the sixes again. Some stability would really do some wonders for the market, and again, allow people to have long-term plans. Rick, to your point, right? If it takes you 2 years to get permits on a project, how do I know what the market's going to look like in 2 years, let alone 6 months? So some stability of the market, some reasonable expectations being set for people, I think will do wonders and allow people to make proper investments going forward.
Yeah, I think, Chris, the market has already priced in some rate cuts from the Fed in September. In fact, there's some discussion going on that if the rate cut is only 25 basis points or a quarter of a point, that we could see mortgage rates tick up just out of disappointment. So I think there's kind of a building expectation that the Fed might cut the Fed funds rate by 0.5% or by 50 basis points at the September 17th meeting. And the market seems to be primed for at least one, maybe two more rate cuts between now and the end of the year. That's kind of predictable if you look at what's been going on, both in terms of inflation, which is now down in the twos. It's not all the way down to 2%, but it's trending that way. And the weakness in the jobs market and some weakness in consumer spending. What's been a little troubling to a lot of forecasters, a lot of economists, is how big the miss was in the jobs reports that we've seen over the last year. When the Bureau of Labor Statistics has to issue a correction, removing 818,000 jobs that had been kind of reported on in the prior months, that's a big miss, and it suggests maybe the job market wasn't quite as robust as we'd anticipated. The most recent jobs numbers have been sort of lackluster or mediocre, not certainly, five-alarm fire kind of things, but nothing to get all that excited about either. So I do think the Fed's on the course to cutting rates. Something we talked about before we went on camera today was the fact that after one of the longest and deepest yield curve inversions I've ever seen, maybe in history, the yield curve kind of uninverted today. And so we actually see that the yields on the 10-year Treasury are higher than the yields on the 2-year Treasury, only by a little bit, but moving in more normal directions. So as of today, the yield on a 10-year U.S. Treasury was about 3.6, 3.7%. In normal times, that means a 30-year fixed rate mortgage would have an interest rate of somewhere between 5.2 and 5.6%. And we're sitting today at about 6.3, 6.4% mortgage rates. So if the market were to just normalize, and if the gap between that yield on the 10-year Treasury and the 30-year fixed rate mortgage would just go back to normal, there's room for mortgage rates to come down pretty significantly. But I don't believe when the Fed announces its rate cut in its September 17th meeting that we're going to see an immediate reduction in mortgage rates. I think that reduction is already baked in, and we're likely not to see rates back in the fives until sometime in 2025.
So thinking that some of the rate reductions have already been baked in because of the anticipated reductions, right? What is that going to do to the existing home listings? How will these lower rates that we're enjoying today, and hopefully a little bit lower before the end of the year, what's that going to do to listings in the existing home marketplace?
We'll probably see some more buyers come to market. I don't think rates are coming down far enough that we're going to see a significant number of new listings from homeowners that were waiting for rates to get closer to what they're currently paying. And we need to keep all this in perspective too. If you're taking out a $300,000 loan, the difference in your monthly payment between a 7% interest rate and a 6.5% interest rate is about $100 a month. So in most cases, that's not going to be the difference between can I afford this house or can I not afford this house. Every little bit helps, as my mother used to say, but it shouldn't be enough to really change the entire context of the housing market. We still have 70% of homeowners with mortgage rates at 5% or less. So it's going to be a while until we get those mortgage rates closer to what most homeowners currently have. That makes it easier for those homeowners to decide to sell their properties, increasing the inventory of existing homes available for sale, which will ultimately help affordability by reducing the rate of home price appreciation. But I suspect we'll want to talk a little bit more about home prices as we go forward.
Without a doubt, we think to ourselves, Chris, right? Like, okay, we have a constrained marketplace of homes for sale in the United States, largely driven by so many folks locking in rates that were just generationally low, right? Like, we may never see rates that low again. But by the same token, life happens. And whether it's on the owner-occ side or in the investment side, sooner or later, that inventory gets unlocked because of events that are aside from rates.
Yeah, people still going to need to move, right? You get a new job, you're starting a family, you're looking to scale up or move for different reasons, right? I think, part of the challenge that you have in the marketplace, though, is those people who are kind of entrenched in their home. And there might be a group of people in the population who are in a home they can afford now, and they would be ready normally for that, step up home. Well, the difference in affordability suddenly is maybe double what you're currently paying, which isn't quite where you want it to be. Maybe you were willing to go up, 25 to 50% of your current mortgage, but not 100% of your current mortgage. And so that part of the inventory that we're talking about where, people have those jobs and they're going to be stable in those positions, and they're probably not looking and interested to sell their homes. That's the segment of the market that really needs to loosen up too, because that's where the first time home buyers want to get into. So, to Rick's point, yeah, we might see more demand, but the inventory is still going to be a little bit of a problem there, right? As low as rates can go, let's hope they don't go back to the 3% we saw before, because that's usually a bad sign for things, right? But what we really need to see the market do is find a better balance between that supply and demand. And in some parts of the country, there's a better balance. Other parts of the country, you see a great imbalance where affordability is off the charts in the wrong direction. And so nobody can get into there. And at the same time, you're pushing people further and further away from those, kind of urban centers, population centers, and things like that, to a point where maybe this isn't the market for us. Maybe we have to go out of state now. And that's where you see where Rick's jumping in there and talking about those migration patterns becoming so important. A lot of investors are following those migration patterns too, right? That's why you're seeing a lot of Sun Belt and Southeastern kind of development in the South as well, because that's where the migration patterns go. That's where the opportunities exist for a lot of investors too. But that inventory needs to be fixed and solved for still. That's still going to be what's driving affordability in a lot of these markets. And if we're not meeting the inventory to match where the demand is, that's going to be a problem too. We could build a lot of new homes, but if they're not the right homes for the market that is demanding those homes, it won't make a difference, right? We need homes that are going to free up that first-time home buyer market and allow people even to get into that next step-up home market. But the luxury builds that are out there, those are one-offs and things like that. There's always a market for those people, but that's not solving demand problems by any means, right? It's workforce housing and the type of stuff that's going to really allow large segments of the population to experience home ownership for the first time, or for investors to be able to provide, affordable, attractive places for people to live as renters, because there's, a theory too that maybe the same segment of the population that would have been homeowners in the past won't be in the future. More people will go to renting and being okay with renting for a long period of time, potentially, because if you're 35, 40, like in that age range, like Rick's saying, and you're supposed to be at the point where you're starting a family and buying your first home, but that affordability isn't there for you, you need to call an audible if you still want to start a family. Now you're looking at a rental path for yourself, something that maybe is a little bit different. So again, there will be demand for rental units too that needs to come on board for the market. Otherwise, we're going to see increasing rents in certain markets too. That makes that affordability index of whether you're owning or renting, both, a little less viable. So there's a lot of problems to be solved, but it's still more on that inventory side of things, regardless of what we can do from a demand perspective, right? I think there's plenty of people who would love to go buy a home, regardless of where rates are today, that they're ready. They maybe saved up their money and they've looked at 20, 30 homes already at all the showings. But at the end of the day, if the inventory is not meeting that market, you're still going to have a hard time there. And competitively, people will outbid each other for the homes that are on the market. And so even though we haven't seen, extreme home price appreciation in 2024, there are still parts of the segment of the population and markets in this country where people are still getting into competitive bidding wars to win a property because they've seen 20, 30 houses and they still haven't been able to get an accepted offer. So there's a lot of challenges out there for those investors. There's also a lot of challenges out there for the people who just want to buy their first home. But it's that inventory side we got to affect the most before we really see some significant change here. Otherwise, you'll see these problems that we're experiencing in this market really exacerbate themselves and become a less affordable place to live. And, we haven't even touched on the other parts of owning a home that cost you money, right? Repairs, maintenance, upkeep, the services for landscaping, snow removal, your homeowner's policy, all the other things that go with it, which I don't know if you guys noticed, but maybe the future generations haven't been as handy as some of the older generations have been. And so people don't want to maybe do their own repairs and maintain their own home at the same level that prior generations really just saw that as part of home ownership, right? You got into this going, I'm going to put some sweat equity into this property and really build for my future, my family's future. Now people are a little bit more on the side of, how do I get somebody else to do this and how do I get them to do it cheap? And that's not always the best option, but that is the mindset that a lot of people are going to have in this market where home affordability is such a pain point that, all right, well, how do I get there cheaper and faster now?
Yeah, that's a lot to unpack, Chris.
Sorry, that's too far.
Let's break things. There's four areas I think are worth covering here in part because of what you just talked about. Certainly affordability, home prices and what they're doing, rents and what they're doing, and what we're seeing in terms of new home development. I'll try and do them all pretty quickly. In terms of affordability, particularly for first-time buyers, things have probably never been worse. Maybe you go back to the 1980s when we had 18% mortgage rates, but generally speaking, the combination of today's rates and higher home prices have made it really, really difficult for those first-time buyers. According to the Atlanta Federal Reserve Bank, if somebody has a median income, in order for them to buy a median-priced home, it will cost them about 45% of their income every month, which makes ownership for that category of people just virtually impossible. To put that in context, most financial folks will tell you, most lenders will tell you that your housing cost should be no more than 28 to 30% of your monthly income. So 45% is just off the charts. And that's a real problem for people. And it's not just in states like California and New York, it's pretty much across the board. What will help over time is that we are seeing mortgage rates start to come down. They're not going to go back down to 2 and 3, but they will come back down to more normal levels. We are seeing wage growth continue. And this is the segue, and we are seeing home price appreciation slow down. So over time, the combination of those three elements, lower financing costs, slower home price appreciation, and wage growth, help the market reset and will help more people be able to afford home ownership. We're coming out of a really weird period of time where the market has suffered extreme whiplash, largely driven by the Fed and its policies. Having a zero interest rate policy for a period of time, which drove mortgage rates down to 2 and 3%, which pulled forward a lot of demand, which made home prices go up 40% nationally, and then hitting the brakes by increasing the Fed funds rate, mortgage rates doubled, and home prices, interestingly, didn't go negative; they just slowed down. So that kind of whiplash is something we really haven't experienced before in the housing market. In terms of home price appreciation, Freddie Mac just released its mid-year report, and what it showed was home prices up about 4.4% year over year. That's getting back to more normal levels of home price appreciation and is down from their June number, which was 5.6% year over year increase. So no matter whose numbers you're looking at, whether it's Case-Shiller or the NAR, in this case, Freddie Mac, Fannie Mae, all of them are showing the same trend right now, which is that home prices are continuing to go up year over year, but they're going up more slowly. And what's also interesting about these reports is that we're seeing that home prices are not going up universally. In fact, about 17 states are actually down from market peak pricing. And if you look at certain states like Texas and Florida, we're actually seeing negative prices on a year over year basis because they did get a little bit overbuilt. In fact, if you look at Freddie Mac's 30 markets that had the largest decreases from peak, 10 of those are in Florida right now. We're also seeing it in markets that were boom towns during the COVID pandemic. Places like Idaho, where home prices went up 47% in a year. So about a half a dozen of those markets in Idaho, Boise, Idaho Falls, places like that are seeing year over year declines. So really important if you're an investor in this market, not to look at the national numbers, but to look at local market numbers, either in your own market or in markets where you might be inclined to invest. And if you happen to hit a market where population is growing, but home prices are coming down, might be opportunities for either fix and flip investing or for buying a rental property. But the good news across the board is that we are seeing home price appreciation slow down. One of the reasons we're seeing home price appreciation slow down is that for the first time in many, many years, the median sale price of a new home is actually lower than the median sale price of an existing home. That almost never happens. But there are a couple of reasons for this. One is that builders are building smaller, less expensive properties to accommodate these higher financing costs that buyers have. But the other is they're building more and more in second and third tier markets. So they're building in less expensive markets where they're seeing population growth, where they're seeing job growth, and not building in some of the more expensive markets. So the list price on their properties tends to be a little bit lower than an existing home that's being sold in Beverly Hills in California. So it's an interesting inflection point in the market that we're seeing today, and the new home prices are actually helping to find ways for buyers to be able to afford these properties. And the final point in terms of pricing and affordability, we can't ignore the rental market. There are about 1 million rental units coming online between 2023 and 2024, adding to the inventory very, very significantly. And partly because of that, we've seen rental asking rates flatten out across the country. Year over year, apartment asking rents are flat. And in many markets, they're actually slightly lower than they were a year ago. The single family rental market is doing a little bit better. But even there, nationally, you're looking at a 2 to 3% year over year increase in asking rents. So in many markets, actually in most markets across the country right now, it's somewhat more affordable for somebody to rent than it is for them to pay a monthly mortgage. And until we see rates come down on the mortgage side, it's likely to continue to be slightly better economically in the short term for somebody to rent rather than own. That doesn't change the long-term outlook, which has proven historically that most people are better off owning than renting in the long run. But at the moment, we're in a very unusual market.
So following up on one of your points there, which it really is a game changer, which is the fact that the average new home price is lower than the average existing price in the marketplace. Let's hone in on what that means for investors today, whether it be buy, fix, and sell, or aggregate for rental. How does that affect their mindset in acquiring new assets?
So, it's always smart to follow the money, Jeff. I know smart investors say that. I think Al Capone used to say that too. But that aside, if we're seeing that kind of movement by the builders going into these markets, it tells me that if I'm an individual investor, I'm going to be looking for market opportunities there as well. And we have to be careful not to mislead people with the numbers. And I hope I didn't do that. If you're in a given market, it's probably unlikely that the new home is selling for less than a similar existing home. we're talking about national numbers. And so the median price of a new home today is slightly less than the median price of an existing home. That's because more of the new homes are in these less expensive markets. And so that's how these averages and medians work themselves out. But if I'm an investor, particularly looking at long-term rental opportunities, if I can buy a brand new home that's perfectly pristine, doesn't require any maintenance, is move-in ready, it's in a nice community of other new homes, and I can buy it at roughly the same price of an existing home, or heaven forbid, even a little bit less, I'm going to grab that one all day. Because I can predict out what my maintenance costs are going to be going forward, which are going to be probably less than if I bought an existing home, which probably hasn't been all that well maintained over the years, particularly in a tough economy. And it's going to be a very attractive home to rent out for people that are interested in moving into that community. And we all know from talking about this earlier, there are a lot of people who would love to rent a home because they wanted to buy a home, but they can't afford to do that in today's market. So you have a ready, willing, and able cohort of people looking to rent these properties. So if I'm an individual investor and I can find a new home at close to the same price of an existing home in a market where people would like to live, I'm going to be looking at that thing all day. And keep in mind that in a lot of cases, these new home builders are offering concessions, sometimes bringing cash to closing, paying points to get down mortgage costs. So there's all sorts of reasons that if I'm looking to invest in the market, I'm going to be taking a good hard look at new homes. On the fix and flip side, new homes are harder to pencil out. But you could look at some builder closeouts if you're a fix and flip investor, where you might be able to get a below market price on a property that you can bring back to market and make some margin on. But remember that most fix and flip investors make a lot of their profit on the enhancements and repairs they make to a property that they buy. The improvements they bring in, they can kind of upsell on their price point. So again, I think new homes might be a little bit more of an obvious opportunity for rental property investors than for fix and flip investors.
Chris, are we hearing more interest from investors on the new construction side of things?
Yeah, new construction has picked up, and we've actually seen throughout 24 just a steady increase in our numbers of activity for demand for ground up construction loans. These are particularly like infill projects where you get an established neighborhood, you're looking to throw a house into that neighborhood. It's a great opportunity. Kind of the feedback we get there is, your profitability can be a little bit better. Your cost controls can be a little bit better from a ground up construction perspective, because it's kind of a known entity, right? There's plans and material costs and labor costs that are kind of baked in. When you're doing the fix and flips, though, you start opening up walls. Sometimes you're surprised, and things don't pencil out quite the way you thought they would. If I ever have a rehab budget that hit the number on the nose from the beginning, I'd be surprised. But, there's always some, level of massaging the numbers when it comes to rehabs. But if you can scale up an operation for ground up construction and find some efficiency within your own crew, you have a real opportunity in front of you to build that inventory that is being sought, and really control that little neighborhood marketplace, if you will. And I think we'll continue to see that ground up construction demand grow. And I think we'll see more kind of mom and pop investors growing into ground up construction as their investment strategy. And even some of the folks now we've seen who have done some ground up constructions of their own, they're now getting into a build for rent kind of market where they're looking at building out kind of not just an apartment complex necessarily, but really a community that is more attractive to somebody who wants to raise a family there than maybe just workforce housing would be. And I think that's an attractive opportunity for a lot of investors who are looking to kind of scale up and go to that next level of investing. That's where we see some of those people take that next step is going into that bigger build for rent community space.
Rick, are build for rents, which were certainly all the rage coming out of COVID, are the build for rent communities still breaking ground around the nation, or have they taken a pause?
No, I think we're actually seeing a little bit of momentum building in the build to rent communities, mostly from the larger institutional investors who are taking money that they previously would have used to go look for individual properties to add to their portfolio. but instead are designating that money to build to rent communities. And I really think it's kind of a win-win. I think if I were an institutional investor sitting on a lot of capital, I think it's a much more intelligent way to spend that money to build these ground up units where they know the quality of the materials and the construction. They can kind of normalize maintenance procedures across multiple properties. They know that they're all in a concentric area, so they don't have to be sending repair crews or property managers all over God's kingdom. And so there's a lot of benefits to doing that. In addition to, as Chris was saying, creating that kind of community infrastructure that's very attractive to tenants. So I do see the institutions diverting funds that they used to use for property acquisition into build to rent communities. And it's also a win for renters because you're getting brand new rental units, usually very high quality. You're getting them at market prices, and the side benefit of all this is these big investor organizations are no longer competing with buyers for available inventory. So I think there's the other win, is that builders are actually bringing new inventory to market rather than competing with traditional home buyers for the inventory that's already there.
So as we look to wrap up here, I'm going to ask both of the guests, how many rate cuts by the end of this calendar year, and what ramification will that have on the owner-occupied 30-year Fannie Freddie style mortgage? Where will we end up for the average homeowner in America? Chris, I'll start with you.
Well, if you're looking at how many cuts, that's maybe a little bit of a harder number. I'd like to cheat and just say I think between all the cuts it'd be by the end of the 1%, right? Like we might get as much as 0.5% this time around, maybe 2 more, 0.25% each kind of thing. I think that would be where I'd probably put the betting money, if you would. But I think the exciting part is that the mood of people is going to change, and that's the primary mover that we're looking for. There is definitely a psychological barrier that prevents people from thinking that they can afford a home, they can get into this market. When that starts to soften a little bit, you'll just see people naturally have that impression that like, oh, maybe I can afford a home now, right? People will just start taking the initiative a little bit more because they're not being told every day on the news and social media that this is an unattainable dream, right? It's not. You're not as far from that dream as you might otherwise think, even in today's market. And I think this will certainly help people get back into the market and maybe participate a little bit more. But I think it's going to be a slower ramp up. I don't think anything is going to be crazy unreasonable. You're not going to see 4 million people suddenly try to buy the same handful of homes or anything like that. Again, inventory is going to be a bit of a curb against that anyway. But as we're also seeing some recessionary job loss numbers maybe coming into play here too, that also means there's some shakeup in inventory for those people too. But they're going to have to change their housing situation. If there is some job loss in the marketplace too, that's going to hurt some people.
Sure.
And that's always a downside for the country as a whole there. But if we can minimize that impact and actually achieve a soft landing here, which would be a heck of a job by the Fed to get that done. They're going to minimize that pain, hopefully. But that would actually be a good sign that we see more of a gradual improvement to the markets there because, volatility is often what scares the markets, right? And so if we see more steady, appreciable growth and we have more reasonable year-over-year appreciation of homes, steady wage growth, these are the things that you'd be looking for to bring stability to the market and really level things out. So I'm hopeful. But more optimistic this year, certainly, than we have been in a couple of the preceding years. So, hopefully we finish out the year strong here. We have a healthier rate environment coming to us, really setting the stage for a big 25 as well.
Rick?
I think a lot depends on what happens with the economy over the next few months. If we don't have any significant decrease in job creation, don't have any significant increase in unemployment, I think after the September price cut by the Fed, we might have 2 more reductions between now and the end of the year. And that's what I would speculate at the moment. As I mentioned earlier, I think the market has already priced a September cut into mortgage rates. So I don't see mortgage rates going down dramatically between now and the end of the year. I think most likely we see a slow, steady decrease over the last quarter of this year and throughout 2025. We probably don't get below 6 until early in 2025 in terms of interest rates on a 30-year fixed rate loan. But it would not at all be a huge surprise to see us well down into the 5s by the end of 2025, which would improve affordability considerably for people who've been trying to get into the market.
Well, listen, Rick, I'm going to hold you to those numbers.
Of course you are.
Severe consequences.
So, hey, this was a great discussion. We covered a lot of ground here. Thank you both very much, and we'll see you again soon. Thank you.
Thanks, Rick.